Greetings, everyone. I'm Kerry Pechter, editor and publisher of Retirement Income Journal, where since 2009, we've been observing and writing about the business of retirement, including the annuity business. Over the past few years, the low interest rate environment has sent older investors and their advisors, and even the life insurance companies, on a hunt for higher yields. That hunt has led advisors and their clients to fixed annuities in many cases. And thanks to their linkage to the equity markets, these products offer potentially higher yields than bonds and CDs or even conventional fixed annuities. But many new issuers and manufacturers of fixed indexed annuities, life insurance companies, that is, have appeared in the last decade. Many rely for their returns on exotic indexes that have no significant track record. Increasingly, they reach for yield by investing in private debt. So how do financial advisors or insurance agents prudently choose a fixed indexed annuity provider? On the basis of insurer strength ratings, on the crediting rates of the contracts, on name recognition, this decision can be difficult if the advisors or the agents hold themselves to a high ethical standard. It sort of narrows them, it requires more due diligence. My guests today, Matt Zagula and Tom Gober, have created a new benchmark for evaluating the stability and transparency of life insurers, especially those that issue fixed indexed annuities. They call it the TSR ratio. T stands for transparency, S for surplus, and R for risky assets. Today, we're going to talk about the TSR ratio and what it does. We'll talk about the challenges that inspired Matt and Tom to create it and why it's particularly useful in today's annuity and life insurance company environment, which some characterize as the convergence of insurance and investments. Finally, we'll talk about the Smart Advisor Network, a new IMO that Matt has created, which offers its members the TSR ratio and other tools. We have a lot of great information to get to, but before we do that, welcome to the webinar, Matt and Tom. And before we jump in, could you just tell us briefly about yourselves?
Tom, go ahead.
Matt.
You go ahead. You kick it off, Tom.
I'm Tom Gober. I've been doing the same thing for 35 years. My focus has been on the deep dives of the financial condition and reporting of the life insurance industry, leaning always towards the consumer.
Kerry, I've been, in the field working with clients for the last, 30 plus years of my career, and more recently started to support other advisors who think like I do. And more so to build product specific to what will be conducive to what we think is the right counterparty type risk with product manufacturing. So that's been my career path.
Okay. All right, then let's dive in because we have a lot of ground to cover. Okay, TSR stands for, well, why don't you tell us, Tom,
Sure.
Since you're the one who does the dig dive into the data, can you get us started here? I've just put up a skeleton there of what it
Sure.
is and what this fraction that is so important here consists of.
Yeah, how this evolved was for 35 years, I have done deep analyses of the statutory financial condition of companies. I've looked at their sworn annual statements with a focus to, are there investments in the higher risk categories in too large a concentration relative to their surplus? So it's fine for companies to gamble a little bit more on some of the higher risk, as long as they don't do it in too large a concentration. So that's one category. Too much of a high risk asset category relative to surplus worries me. But on the other side, a lot of the for-profit companies have done a significant amount of reinsurance that I consider more of a sleight of hand involving non-transparent, as you've written about, the Bermuda Triangle, Bermuda, Barbados, even some of the onshore captive states, allow these companies to not make their financials available. So you've got high risk assets, reinsurance that may not be designed as much for risk transfer than for balance sheet appearance. Those combined relative to surplus gives me a ratio that tells me the relative risk levels of the life and annuity industry.
Okay, and then Matt, what is your how do you explain this to people so that it gets across quickly?
Well, I think that's what the TSR is all about. It's a single number. The lower, the better. The higher, the more concentration you have relative to surplus. I think what was important when I first met Tom, I was looking at a client. It started with a client, and we were looking at a non-rated fraternal that I was very familiar with, very comfortable with. And I brought Tom in to do a full-fledged report. Well, he gave me a full-fledged report. All right. It was quite a report. Would have been great to testify in court with, but it was not digestible by the average person for sure. And I asked Tom, I said, look, what are the big areas here? He said, Matt, it's the riskier assets as defined by the Federal Reserve, which made me feel good. It wasn't Tom's opinion. The Federal Reserve said these are riskier, and riskier doesn't necessarily mean bad, Kerry. What we're talking about here is that they have likely more limited liquidity in a sell-off. So it's a liquidity crunch that's driving down price, but it's helping them kind of prop up yield, but they are identified as riskier assets. So riskier assets are fine to an extent, and also the use of what he called opaque or non-transparent captive or affiliated transactions, where the company was using their own company just in a different jurisdiction to reduce their liabilities, all relative to surplus. And I think that's what makes the TSR different, Kerry, is that it's all about how much of this are you doing relative to surplus. And that's really what differentiates the TSR from everything else, because the money that's in the insurance company, that's the policyholder's money. It's not the insurance company's money. And that's where I think things have gone a little bit awry. That cushion, that surplus is what protects the policyholder's money, because if it goes away, that company is deemed to be insolvent.
Okay. And the way I understood it also from some of our conversations is that the conventional comparison is surplus to total assets. Is that right? And then you're measuring surplus to risky assets.
Yeah, no, I understand what you're trying to get at. The rating agencies, and frankly, the NAIC, they have always looked at categories of assets divided by total assets. And there was a time years back when that told you something. But when a lot of these companies have grown so fast, buying in blocks of business, their assets are soaring, but they're keeping their surplus at a razor thin margin. They're choosing to have lower levels of surplus. So if you look at a company, let's say that a rating agency says they only have 1% in this category, they're referring to 1% of assets, whereas relative to surplus, it might be 120%. So it's much more important from my perspective and the consumers to always remember, what is the buffer? What is the excess of assets over liabilities? And that buffer is the most important number in the annual state, in my opinion.
Tom, Kerry, we were looking at a company just the other day that said, hey, we have less than 3% in collateralized loan obligations and residential mortgage backed and in commercial backed securities. But the reality is, when you take that 3% number as a multiple of the total assets and compare what it is to the size of the surplus, it was almost 1,000% of what they had in surplus. So if there's illiquidity there, that company could have quite the trouble, based on the fact that they have risked very heavily in those deemed to be by the Federal Reserve and the NAIC as higher risk relative to surplus, not to the total assets, which are not theirs.
Okay, well, let's visit this. Let me see if this.
Yeah, I'd like to comment on the data if that's okay.
Yeah, this is let's make it clear where your data is coming from.
Sure. First of all, literally every data point that is pulled into my analyses comes straight from the company's own sworn annual statement. Their statutory blank, a lot of people call them. They have to file that each year with every state in which they operate, and with the NAIC and with the rating agencies. I use those data points of theirs and simply pull in the ones that the Federal Reserve, the Treasury, and even the NAIC now are calling attention to, those being less traditional, being more likely to have a liquidity issue under pressure. I pull all of that into my analysis. So everything is from their own sworn statement.
The one thing that we need to make clear, and I think that maybe I'm try to express some of what I've heard from my readers and other people, is we're talking about, these are the very assets and maneuvers, let's call them, because that's like reinsurance, that a lot of people are cheering, that they have, added stability and profitability and higher rates for the clients to the companies. And so, but you're saying but you're casting some doubt on that, it sounds like.
I am. I can't agree with increasing stability. All of the issues we deal with, the higher risk asset categories relative to surplus, and a lot of this reinsurance, it often is literally ceded to a wholly owned subsidiary of the company. So the point is, you're not looking out, as reinsurance used to be, to an independent entity that has its own money. You're not saying, oh, good, we have someone now that has our back. These are your own sister companies. But then worse, the fact that there is no transparency, that we can't see the substance of the transactions, which is so important. I have to disagree on the stability. I know that a lot of people champion taking some higher risks on their investment portfolio. I agree there is a place for it. But when you get into the 6,000%, one of the companies that's around 6,300%, just in the commercial mortgage backs, the other asset backed structured investments, they had more than 5 times their total surplus in that one category alone. And it's the feds, not just Tom Gober, but their reports they're putting out are saying, they're getting into some really high concentrations on those.
Yeah,
Does that make sense?
I want to emphasize that part of what our motivation here for looking into this area came from concerns expressed by people at the Federal Reserve, not the Federal Reserve, but economists at the Federal Reserve, as well as, and I've been getting calls from and comments from people in government and from actuaries. And there's behind the cheering, there's a fair amount of concern about the risk. But it's kind of getting drowned out, because really every time I pick up the Wall Street Journal, I read about the amount of money that's pouring into private credit and private equity funds, since people are looking for yield. Now, I want to give just an example. But can you tell me just quickly how a company can get to 6,000 and another company can be 45? What is that? Let's say a number. Let's say the surplus is $1 billion and the assets are 50 billion, and everything looks fine.
The company, let me say this, the story has become much clearer with time. The more I look at these transactions, the better I understand. Understand that going back 700 years, insurance has always been a mutual type, a cooperative, where the people paying premiums into the pot
Mhm.
were the people who had claims coming out of that pot. And there were no other hands reaching in. And so as companies demutualized and added a second mouth to feed, the investor is not just a second mouth to feed. They have lobbying power. They are sophisticated. They have online real-time data collection. And the consumer, for whom the company was formed, takes a back seat. And so why is that an issue? Because those investors demand stockholder dividends, cash out of that pot. And so all those years, premiums came in and only claims came out, and you had fairly static expenses. But boy, when you started paying cash dividends, you understand a stock dividend out is gone. That's not money that can come back. They also use that for stock buybacks, things that are good for the investor that frankly put the consumer in second place. So one last point. So as you go up as high as you can on premiums, get as much premium as you can, and you're delaying claims to try to manage your daily profit level. One other place you can go is to roll the dice. If you can squeeze out a little higher yield, then that makes it easier for you to afford to pay stock dividends. It just happens that those categories of activities of a for-profit, frankly, are not in the best interest of their own customers.
And Kerry, to kind of follow up on that, I do think, some higher risk assets to enhance the overall yield we're not suggesting that it's necessarily a bad thing.
Not at all.
It's the sizing of it that's troubling. But what's more troubling is what Tom said a moment ago, which is, when you have, how do you get to 6,000? So you have a carrier in your example that had a $50 billion asset base, right? And perhaps, whatever state they're in, and these numbers are not relative to anything, just as an example. Say that state says, hey, you need 45 billion reserved to make good on the promises you made. But that same company opens up a different company that they own completely 100% of in, say, Barbados. And this is just numbers. These aren't accurate numbers. These are just for illustrative purposes. And you say, hey, down here, we look at things a little differently. We only need 30 billion in reserves. Well, you immediately just financially engineered a $15 billion influx that could be paid to shareholders, could be used for bonusing, could be added to surplus. You've changed the entire risk profile by being in a different jurisdiction. And I think those are the most troubling. Yep. Because from a street perspective, when we're serving clients and helping them, they're relying on lifetime minimum income benefits and long-term promises on life insurance. When they start reducing the amount of reserve for the promise made, the follow through to make that promise good becomes weaker. And that's the big problem that I see. I mean, a little bit of higher risk is okay. It's just don't go crazy relative to your cushion, your surplus. Right. But these transactions really just limit the amount of reserves in a comparative format that's not beneficial.
Right. Sure. Of course, how you look at this, your position in the marketplace is going to determine how you look at this. If you're a shareholder in a publicly held life insurance company that's been struggling to make profits over the past 10 years, then you might be thrilled by these developments. And but we're not going to demonize any business model, and we'll get to the implications of business model a little later. But right now we're looking at this from the perspective. I think I'm looking at it from your perspective, Matt. From the advisor who has to go out and put his reputation behind a particular company and who has to deal with the greater pressure. Investors are getting smarter and they're learning more and they're expecting more from advisors and agents. And so if we leave the shareholder view behind for a moment today and look at it from the advisor, the conscientious observer point of view and his client's point of view, then I think we're I think that will frame it better for our audience wherever they're coming from. The next slide is interesting because it shows you, it gives you it lets you visualize the world that Tom lives in.
My favorite. Schedule S, Part 3, Section 1 is pretty much where I live. And what it presents to the reader of the financial statement is who the life insurance company is looking to have their back. Reinsurance is like insurance for an insurance company. And column 9, you can see I've got a couple of highlights there. That's reserve credit taken. We've anonymized this here, but you can see there's one about halfway down that's close to 2 billion. And that particular company I know to be a fairly high risk entity itself. So what this tells us is, are they going to independent, strong reinsurers that can honor that have your back if things get tough? Or are they dealing with entities with lack of transparency?
And
all
Tom,
that is here.
I do think, like, and I giggled because I when you say, I mean, the things we talk about are, I mean, ridiculously nerdy, but this one in particular, I do think, Kerry, is really important to stress. And thank you for cutting it the way you did, so that we don't like throw this out there. But if you were to call this particular reinsurer, okay, and you took it off of their annual sworn statement, and it's called the Jurak page, is that right, Tom? What's
Right, Jurak.
So this is an annual sworn statement. An individual will answer the phone on a voicemail. There's no home office. That's $2 billion of risk that's put onto an answering machine. That's troubling. And that amount of laying that off allows this particular company that you've also hit purposely not put out there. It allows them to write an enormous amount of premium relative to their actual surplus. They are running razor thin for the amount of business that's being pushed in the marketplace by the marketing organizations who don't understand a lot of this. I don't think they're bad people. They just don't understand that the amount of sales relative to the actual assets and surplus there, the cushion is ridiculous.
And also, to be clear, some of the rating agencies have come right behind us recently and raised these exact same concerns on the same companies. So we're not alone here. And again, it is a positive message. What we're trying to do is say, keep an adequate amount of surplus. Don't take too many risks, because remember, what we're talking about here are annuities. We're talking life and annuity contracts that are long-term. And even if you have the perfect designed product, just right for your needs, if the company can't make it 9 years out, the product is no good. So you just want a company that you can count on.
Okay, let's move along. Well, we've already started to get into this. But here's a question. These are important questions that, I mean, aren't the ratings agencies telling, and we're talking about some of your high TSR companies with a high level of risky assets or reinsured assets or affiliated assets. They have A ratings from the ratings agencies that everyone respects. And when I call those rating agencies and they're not, I mean, occasionally they do issue press releases that say we're we're watching this closely and we think that and then other people say, well, the state regulators would have cracked down on anything that is not good for the consumer. So why is this so necessary? Isn't the status quo? Isn't the system working?
If I can take that, Matt, this is really interesting to me. Remember, I've been doing this 35 years, and I started as a regulator. I was an examiner, and I examined insurance companies. And the first thing I learned as an examiner was this thing called the basket clause. And it was called the basket clause because of the old saying, never put all your eggs in one basket. And so every state said, okay, in the basket clause, you cannot invest more than 2%, or some went 5%, and the highest I ever saw was 10% in a given category of asset. Today, I don't know what has happened, but a lot of these companies have 1,000% of surplus in one category. So it seems like over time, the industry has outpaced the regulators. And you got to understand, they're underfunded, they're understaffed.
Mhm.
And the ratings agencies, they will mention that a company is using captives. The rating agencies will mention they have X% of their total assets in a given high risk asset. But remember, in order for that information to be meaningful for a long-term contract company, you have to compare it to surplus. And they're just not doing that. And remember, in 2008, when things got so bad, the ratings agencies had good ratings on those companies too. You know, it's not easy.
Hey, Kerry, if I can add something to that, the
Sure.
rating agencies, I think in their DNA and their core, they look at assets. I mean, that's just kind of who they are. So these liability kind of arbitrage ideas that are going on and happening in pretty gigantic volumes today. I don't think that they're looking at those the same way they look at the assets. And I think Tom would agree with that. Tom, is that fair? And then the regulators, I think, I do think they're really trying. I think the issue is that they review external audit papers that are paid for by the carriers. And Tom, I don't know how many times whenever there've been a really big, serious problem that the auditors aren't included as part of the major problem, So if there's a fraudulent situation, I mean, those auditors are almost always included. So if you read bad stuff, Kerry, you can't make, I think they're severely limited by that. So I don't think either of them are bad. It's just a different view.
But to a compliment I must give to the regulators in the NAIC is their recent focus. And Kerry, I think you talked about this in one of your publications, that the NAIC is more concerned now with the private equity groups muscling in on the life and annuity companies. And the NAIC has promised to keep a closer eye on what those companies are doing and what kind of risks they're taking.
Okay, well, let's unpack that muscling in idea for a minute, because it sounds a little nasty, and let's talk about what we're actually looking at. I think the fear when you say muscling in, I think you're expressing the view that that large asset management companies are seeing the annuity sales by owning life insurers and selling annuities themselves. That this is not a secret. They look at the annuity business as a source of inexpensive capital or inexpensive assets with which to feed the rest of their machinery. And
there is no doubt that in their own words, when they speak to analysts, they brag about the fact that they've amassed all of this, what they call permanent capital or sticky capital. Those are promises to your customers. Those are life, future death benefits, and annuity products. And so they speak of it as, we're able to pull together all this money we can invest. And that's just a different mindset. Remember, I started as a regulator. 35 years ago, the mindset of an executive of a life and annuity was a long-term thinker. You had to be. But I think we can agree that the private equity groups do not look as long-term, especially with respect to their liabilities.
Well, they certainly, when the private equity companies first came into the life insurance industry after the great financial crisis, people were afraid that they were going to behave. People understood them as private equity companies, and that would buy a company and pump it up and sell it and get at that their private equity investors wanted to realize a profit a big profit in maybe 7 years. And it's turned out a little differently from that. What we used to think of as private equity companies now talk about themselves more as private credit companies, that they are creating customized loans. And ultimately, it's these loans which get securitized and which have a higher, or supposedly have higher returns for their risk level, that they are supposed to be perfectly, I mean, they're exceptionally skilled at finding companies that are going to pay their bills and that are risky enough to pay high interest rate. So that's changed a lot, and we can't go into all those details. But the point is that the life and annuity industry and the fixed index annuity products have changed dramatically. And I want to show you a couple visuals, because I need some visuals to anchor me here, because once we get too much into words, you can't really see what we're talking about.
Understood.
So this is the way I think of, and some of you in the audience are going to, have a much more, a higher resolution view of what's going on. But this is, when I talk to people, this is kind of generally the idea they have about you have an annuity buyer and works with a captive or an independent agent of a life insurance company, and they invest in the annuity as the annuity for them is a kind of investment. They're not going to turn it into it's like a super CD for them. So the life insurance company then invests in bonds, and those bonds are bought from large corporations. And then classically, you see the big insurance company, the big old mutual companies sponsoring things like, 50-year apartment complex, towers in New York City. So the classic assumption was that the bonds will pay 4%, and that the insurer will pay the policyholder 2.5%, say, in a fixed deferred annuity, and will take the 1.5% as to cover its own expenses. And I used to think very naively that before I started finding out that I thought 1.5 is not a very good return. But actually, it translates when you focus on the return on equity. That equity is only maybe 10% of the assets, and so you're earning 1.5 on that much smaller amount, which turns out maybe to be 10%. So anyway, so they weren't, but this was a stable business. It kind of reminds me of the savings and loan business that we saw in It's a Wonderful Life. Here is the way I and others, depict. If you go on Google Images and you look up, the processes that are being used now, it looks more like something like this.
Right.
And I'll distribute this slide to anybody who's interested in it, and I'm sure that some people out there are going to know a lot more about some of this than I do. But what we have here is this slide particularly depicts the special situations in which a big asset manager's holding company owns the asset manager and the reinsurer and the life insurance company that builds the insurance companies and has deals with distributors, and is working in a very, this contributes to so what you have is, well, how do you guys explain, how would you guys explain the Bermuda Triangle quickly to somebody?
Matt?
I don't think there's a quick way to do it, Kerry.
Okay.
And I don't believe that it's something that, with a client that, I mean, we're working towards.
No, this is not for, this is not
going to be for for someone to digest that you're working with on an actual case. It's a problem. I mean, that's for sure, but it can be very problematic. You're wearing all the hats, but this isn't something I would talk to about it with the client. Now, if I was talking to an advisor, I would explain, obviously there is it's all under one roof, and when everything's under one roof and you can limit your liabilities in these protected cells, and then you got these sticky assets under the AUM, and you're basically self-dealing with yourself, there's a lot of places where inefficiencies can pop up here. I'll say that.
You know, one really interesting point that no one ever talks about, and it's really crucial on this Bermuda Triangle point. All of these new private equity groups, they are putting the holding company, the company that is actually in control of the insurer's actions, offshore. And that used to never be the case. It was always the immediate controlling entity was in the US. And nobody's really noticed that. And once you realize that, it means that our regulators in the US, they might can see this end pretty good, but what really matters are the transactions being done with a company that is offshore where there's not as much transparency.
Yeah, just to give you an example of the way these, I mean, depending on how you look at it, these are either synergies or they're conflicts of interest.
Right.
Depends on who's describing them. But let me just give you one example as I understand it. Let's say that you have a life insurance company is going to reinsure some of its books of business with a reinsurer that it owns, or maybe the reinsurer owns the life insurance company. And it's in a place where they use GAAP account, where they can measure the liabilities in GAAP accounting instead of SAP. And we won't go into accounting regimes because that's a vast hole. But anyway, so they're doing it with their own reinsurer. Now, in the old world, the reinsurer would be a completely separate company, and they would negotiate with the life insurance company about the amount of risk that would be taken by the reinsurer once they got the assets, and there would be a push and pull. The reinsurer would want to take more risk, maybe, and the ceding life insurer would want to, and they would have a discussion, and there would be some tension there and some. But when you have both of them owned by the same holding company, you take away the checks and balances.
Kerry, that is an awesome point. Really, no one has said that to me quite that way before. But that's the real issue, because in real reinsurance, what used to happen typically, the reinsurer was not merely a company that had your back with its own capital. It was a source of information and professionalism beyond even the life company, because they see the data of all companies, not just a given company. And so they're there as your partner. But when the same man who controls the ceding company also controls the assuming reinsurer, and as you say, every aspect of the investments and everything, you lose one. The biggest problem, in my opinion, is that it's not outside money, but you also increase the odds that transactions will not be arm's length, because it's the same person controlling the shots on both ends.
And I think it goes to the third point too, Tom, which is, Kerry speaks of it as tension. There's a negotiation between a life insurance company and the asset managers over fees and expenses, which, I mean, in a low yield environment, those are critical, right? If they're all owned by the same entity, that tension is no longer there. So you get to
checks and balances.
You don't have any checks and balances. Everything's under one roof. So it's where do you want the money to land?
And well, let me offer a caveat here in case we get over. Not every company uses this kind of method. There's lots of deals going on where there are arm's length, and there are many variations. We're talking about this because it's the biggest sellers of fixed indexed annuities today are using this.
That's exactly right.
That's why we're talking about it. It's not, even though this is not there are many variations on this, but that's why we're interested in this. Okay, so let's move along.
And I'd add, Kerry, it's more profitable to run at a thinner surplus whenever you do things like that.
Oh yeah, of course. Okay, everybody's in business. I mean, there's certain business facts that we have to, deal with, and we're not questioning some of the things that have to be done to keep a company healthy. But now we're talking about implications of this. These are some of my takeaways. The business models and the ownership structures of life annuity companies matter.
Yep.
Why? And hardly anybody looks at that. I've had people say, well, I never considered, the difference between, I never thought about who owned, what the ownership structure. But I mean, Tom, I know you've thought a lot about this. I mean, you can say it pretty succinctly, I think.
Okay, so it all comes back to the purpose the insurance company exists. And if they're a fraternal or a mutual, the tendency is far greater that decisions are made because it's in the best interest of their own customers, the people who pay the premiums. As you get away from the mutual or fraternal model and get into publicly traded and wanting the stock price to go up, wanting your options to go up, then the tendency is to be more aggressive in a variety of ways. And as Matt just mentioned, one of those ways is to get as narrow as you can on your surplus to put that money to use. And I don't like that concept. Obviously, I care about long-term commitments. But the bottom line is, if the company is not taking excessive risks relative to surplus, they're a good company. They're committed for the long term. But some of them they've just gone a little overboard,
Okay.
frankly.
Well, Matt, let me ask you this. There's a widespread assumption in what I read and in what I hear that the greater profits from these risks, though it could all come back to bite somebody in a downturn, but that these profits are passing through to the annuity owners through higher crediting rates, and that this is working for the annuity buyer. Is that true? Is that true that you associate higher TSR ratios with better crediting rates?
Yeah, I'm listening to this, Matt. I'm listening to you now.
I mean, I would say that that's an impossible question to answer. Here's why, especially on an index product. I mean, if you had just fixed annuities, it would be easier and more transparent because you'd see what the interest rates were relative to companies that have higher TSR ratios to lower. But I would say two things about that. First, the published rates on participation in indexes is very confusing, because you could have somebody who created a new hybrid, what I'd call cherry-picked index. The options are cheap and they're flowing over as little money as possible, creating greater profitability for the carrier. The second thing I'd say is that often companies that are showing the biggest crediting rates are those that are the most challenged from a financial perspective. If they're trying to backfill financial problems with new premiums. I think that's an enormous problem. So I don't feel that I can comfortably answer that. I would say what Tom did say is correct. When you have a company whose sole purpose is for the policyholder, fraternals and mutuals, they are likelier to do things to benefit them, right? Now, the stock folks, I feel bad. I mean, there's a lot of good people that work at stock companies, and I think they inherited a situation where they do have this, as Tom said, extra mouth to feed, and that mouth is the one that puts the money up. So I would just say, from an annuity issuer characteristic that we're looking for, is I do favor in every instance a fraternal and a mutual over a stock company, from me delivering value to my client that I serve. And I feel bad saying that. There are some stock companies that do exhibit reasonable, seems to be reasonable behaviors.
Yes.
But they could be under pressure next year from the shareholders to give them more, and you don't know. And I think that extra mouth at the table to feed is the issue.
Yep.
I hope that was sufficient, Kerry. I know you wanted a more specific answer, but unfortunately they don't publish those rates, so it's impossible to say.
Okay. Well, I think we're about ready to move into a Q&A.
I saw some good questions coming up.
And
There is something I see popping up, the generalization of mutual versus are there differences in these mutuals? And Tom and I, without going off the deep end here, there are some vastly different behaviors in the mutuals.
There are.
Yeah. And some of
Yeah.
the names that you guys just popped up, there are issues with what you said, and some of your assumptions that you're alluding to are correct.
And
Okay.
Matt, that's again why the analysis we do, the TSR, it doesn't stop at, well, this is a mutual, so they must be okay.
No.
Some of the mutual groups, the mutual name itself might have a fairly conservative balance sheet, but they've grown, so they, in their holding company chart, they'll have other companies that are life and annuity carriers that are like night and day from the conservative company, where they are taking the same risk. And that's why, even if it's a mutual, you still look at their TSR.
And that's where I was so impressed, Kerry, with the TSR, because, Tom and I have been at this for a while. From year to year, we noticed a company, and I'm not, no names, but that is currently in the process of demutualization. We noticed a tremendous shift in TSR as it related to captive transactions to prepare them for the eventual demutualization. But at the time, we didn't know exactly what they were doing. And of course, they weren't telling anybody at the time, but we had flagged them saying, this is a very unique scenario where a TSR is just taken off like a rocket. And so, it did give us that forewarning of, hey, keep your eye on this. There's something going on here.
okay, here, let me get to some of these questions. One person asked, will you share the names of the insurance companies that have the high and low ratings? And we talked about this before the webinar, the three of us. And I think we settled on the idea that we were going to talk about that the companies we were going to name that were companies that that have come to the surface as large companies with good sales, with high capacity, who were in the range that Smart Advisor Network was going to recommend. And you named a couple of those companies, and I'd rather, I just have a sense that it would be better to do that than to name the extremes. We'll let people, and also because this is proprietary information to Matt and Tom.
Kerry,
And
the issue I think sometimes in naming today is in that demutualization example I gave you. A year before, they literally doubled in TSR in a year. So my concern and the reason, digging through these annual sworn statements, they average, Tom, how many pages? 1,500 to 3,000?
Yeah, to 3,000 pages. They're very detailed.
So we've created a process to be able to do it efficiently, but it is an enormous amount of work. And in one of your slides, you did mention a fiduciary process, right? So many people today are holding themselves out in a fiduciary capacity to their client. And I do feel like folks that are doing that do have this step beyond a rating. It's an A-rated carrier. My covers it. That's the due diligence done on picking the investments is much greater than that. So what Tom does is make the due diligence on these carriers much easier. The problem with just saying, hey, this is good, this is bad today, those numbers can change, and that's why this is an evolutionary process. And one of the reasons why, for you, we did say that we were going to. And because of you, we've reduced prices to get this more in the hands of folks, the data, if they want it, so that's one of the things that we did as a result of your recommendation, that people need to know these things. And you were at the forefront with the Bermuda Triangle. So that's what we've done.
okay,
Yeah, there's a TSR report for each entity, even where there's multiple companies in a group. We have a separate report for each company. And that way, they get the details of what's going on within a company. It's not that we don't want to name names. It's just, we don't want to make people uncomfortable, right? But if they go to the TSR, they can not only see the reports, but see where people stack up. As we said, the best I've seen today is a 45, which is unbelievable. That means that only if you took all of the high risk activities of that company and wrote them down 100%,
They're still
they
solvent.
still have surplus.
Mhm.
On the
Okay.
other end, we see them in excess of 6,000%. One of the companies at 6,327. That means that they could only take a write down of 1.6% of all of those risk activities before their surplus is gone. And so it helped, 6,327 is a high number. High is bad. But it translates to that company doesn't have much room to take an economic downturn.
2% would 2% would take the surplus out and put them into insolvency.
And you've told me that people have a false sense that a holding company with $80 billion a year in revenue is going to step in and save the life insurance company if it's investment, or the reinsurer if the investments go down. And you said that they have no obligation to do that.
It's an extremely important point, especially for people that are advisors and agents. If you go to any product, a life product or an annuity, in fine print, it has to be there. The company, their promise to you is only backed by the surplus of the underwriting company. It is not backed by, if you've got a big private equity group at the top, don't count on them putting money in. That's not really their job. They want to take money out. So the importance is what they call standalone. The standalone is based on that surplus, and that's what our TSR focuses on.
And Kerry, if I could add, this is the number one thing I think that's dangerous in this industry, and I don't know how they do this, but they will actually put logos of financial institutions, not naming any, like big ones, like ones that would make you feel like, hey, they got me. But all that matters is at the bottom who it's guaranteed by. That logo doesn't mean a darn thing. It's like marketing sleight of hand. It's not real. It doesn't mean anything. There's no guarantee implied.
That's why we have to go back to surplus of the company.
Okay. Well, let's get back to a couple of these questions.
Okay.
We have somebody who says, okay, well, what about some of the challenges associated with being a mutual or a fraternal? They don't have ready access to the capital markets to raise additional capital if needed. And many of the smaller ones have struggled to grow because they can't offer competitive products, because they do not have the investment expertise and do not have an extensive marketing budget. Do you share those concerns?
From my perspective, we are seeing great fraternals step up to the plate because there is now finally a momentum behind truth seekers. And there is momentum behind focusing on the consumer. So the migration of people away from the really, really high risk companies towards some of these companies grow in amounts that they can manage. That's what our TSR shows. They have enough surplus to grow at a meaningful rate. We're not looking for them to become a giant entity overnight, but the migration, we really feel like it is a meaningful concept of helping people who want to be able to count on their long-term commitment, to migrate them away from the really high risk takers to the ones who care more about long-term.
Okay. We have a question here from David Macchia, of the founder of Wealth 2K, the income generating plan company. And he asks, given that the financial machinations of an insurer may remain weakly understood due to opaque financial reporting, or even worse, be undisclosed due to offshore arrangements, relevant information that never gets recorded in statutory reporting, how are you able to generate a ratio if you are unable to gain access to the carrier's true financial picture?
That is an excellent question. I'm proud of that person. First of all, I live in these annual statements. the footnotes, the general interrogatories. I look at every aspect that's within the statutory blank. What that person, I believe, is talking about is that there are transactions that occur off balance sheet. And so when I talk about these captives, their balance sheet is secret. That's why we aren't saying the captive doesn't have enough money. We're saying because we can't see it, the very penalty we assign is because we can't get to the number that he's talking about. Where all of the asset information is straight out of the balance sheet and it's true. It's relative to surplus. With the reinsurance, and reinsurance is my specialty. I worked on criminal cases for half my career involving sham reinsurance. So it's a huge issue, but what we have to do is say, look, as long as you do non-transparent transactions and we can't see, just like he's saying, because we can't see it to confirm it, we have to leave it in that question.
Kerry, if you think about a company going through the whatever the administrative hurdles they have to go through to move it from a U.S. jurisdiction offshore, right? That they own both. The best example the way I'd answer that question, not in the intelligent way Tom did. If you had a neighbor with a door that was locked and had all these locks and chains on it, and you heard scratching noises behind it, you might assume there's bad things going on back there. So when you can't see what's behind it, the assumption is that why did we go through this move if there's not something down there that has chopped away at the promise that was made to the policyholder? And that's why they get dinged 100% because nobody knows what's in there, not us, and it's not transparent. That's
Kerry, I don't know if you make it available, but there's several great research reports in the last couple of years about these very issues, that captives are a concern. I'm wondering if you could make some of those available. I could send those articles to you and maybe you could forward them out because
Sure.
They go straight to all these points.
Okay. We have a question from Scott Hawkins, an analyst of this industry and an expert that I rely on sometimes. He asks, can Tom explain the differences in reinsurance types, for instance, funds withheld and ModCo, modified coinsurance, and how that impacts his analysis?
Yeah, and I can talk a lot about that, but we don't have time.
Yeah.
But quickly, let me say that modified coinsurance is a unique invention that was designed originally where you hang on to the money here in the US, because back when the German reinsurers were the big ones, Hanover and Munich, during World War II, the regulators became concerned that the money would be in Germany and we couldn't get to it. Unfortunately, it has turned out that they're using these ModCo transactions to get significant enhancements to their RBC. So they can keep smaller amounts of surplus by having done a bunch of ModCo. And sometimes the ModCos are literally with just their own subsidiary. See what I'm saying?
Okay, well, that's a deep topic.
Yeah,
and
sorry.
No, that's fine. The people want to know.
Yeah.
There was a question about the well, here's a there. We focused on fixed index annuities, but people have questions about different kinds. It says we have a question with variable. At least you've got assets in the pooled separate accounts until they're exhausted, and you get so it'll be a problem when the contract owners may be ill or cognitively declined and least able to defend themselves. I think that's on a different topic, and it's important, but I don't want to go down that road. Another question, in the last few years, many of the large corporations have transferred their pension liabilities to insurance companies in the form of annuities. Is there a concern here? Okay, well,
Very
yes,
important.
we're going to have another discussion about pension risk transfer. It's analogous to everything that we're talking about here. It's generally been the province of huge, counterparties, I mean, we're talking about a MetLife and a Prudential and a companies with vast, and Athene is been pushing into that quite a bit. That's we're going to have to hold that for another day, I think. But
it's an important one, a good question, and I'd
Yeah.
like to help at that point, at some point, if you need me.
yeah, someone's asking for the slide deck and presentation that will be available. We are out of time. We have lots more questions, and we're going to have to think about a follow-up. But I hope that what we hope to accomplish here was to take a huge, hairy topic and show you that there is now a tool, this TSR ratio, that is available to just start. It gives you a grip that we really have never had, and that's why I wanted to bring it to my audience. Gentlemen, Matt, if people are interested in the Smart Advisor Network, how should they contact you?
I think the best way for everybody on this presentation to get familiar in general with what we do is the tsrratio.com. I mean, that way they can start looking at the tool and using it. And then, you know, from there, we tell them about the products that we've developed, that were all developed based on looking at the carrier's TSR ratio first. So we actually pick the carriers we want to work with before, based on Tom's analysis of the companies.
And soon they will be updated. You understand the annual statements aren't turned in until about March 1. So very soon after March, I'll be updating all the ones from 2020 to 2021. And
we make this, it's an online system, Kerry. So when you have the TSR ratio, you can just go in and look up any carrier. If for some reason there's not a carrier there, if they put it in within a few weeks, Tom and I get the report,
I'll have it
posted up for them. Yeah.
Okay. Thank you. Thank you for everyone who tuned in for our webinar, and thanks again to Tom and Matt for the valuable work that they've done.
Thanks
Everybody
for being patient with us and my nerdy self.
Yeah, if you're not a nerd in this area, I mean, then you're in the wrong business.
Okay, man. Thanks, everyone.
Thanks, Kerry.
Thank you.
Bye-bye now. Bye, Kerry.